Earlier today, the first estimate of first quarter real GDP growth was estimated by the government at 1.6%. While that is slightly lower than the consensus forecast, personal consumption expenditures remained a positive at 2.5%. The negative reaction to this report does not originate from the GDP number, in my opinion, but from the PCE inflation numbers. PCE stands for personal consumption expenditure, and that inflation measure is preferred by the Federal Reserve compared to the CPI number. In the first quarter, and it's contained in this GDP report released earlier today, PCE inflation was estimated at 3.4% compared to 1.9% in the fourth quarter. PCE core inflation was up 3.7% compared to 2% in the fourth quarter. A continuation of this kind of trend for much longer would make a rate hike more likely than a rate cut. To hit those PCE inflation numbers for the quarter, the March number, which has not yet been released, will have to be much hotter, I think, than previously expected, or the January and February numbers will have to be revised higher than previously reported. As previously discussed, this inflation report confirms my previous estimate that there will be no more than 125 basis point cut in the federal funds rate on or before the December meeting, and I would take that off the table with a few more months of inflation trending higher unless the economy is clearly in a recession. I checked the CME FedWatch tool at about 8 o'clock this morning, April 25th. No rate cut on or before the December meeting at all, no rate cut at 19.1%, up from 0.6% a month ago. The more probable than not scenario is no more than one rate cut, which stands at 80.9%, and I would not place it that high based on what I'm seeing now in the inflation numbers. The chance of no rate cut at all on or before the July meeting is now at 68%. The market is factoring in a 58.5% of a 1 basis point of 125 basis point cut on or before the September meeting, with 41% at no rate cut at that meeting. So the market is really taking back its previous forecast of 3 rate cuts and is now expecting no more than 1 before year end. Fuel for the downdraft today, in addition to the inflation numbers, includes the major negative reactions to Meta Platforms and IBM earnings reports, which I do not own those stocks, as well as a 9 basis point increase in the 10-year Treasury yield to 4.73% in early trading today.